The Magnificent Seven are tech-oriented companies. They make over 27% of S&P 500 ETFs. And when we just look at the performance in 2023, every single one severely outperformed the S&P 500. We have Apple, the worst performing of those, up 48%, when we see the S&P in 23 up 24%. And in today's episode, we're going to take a look at the Magnificent Seven, how they've performed against each other over the last 10 years, looking at just one of them to buy now for some incredible growth over the next few years, and we'll also discuss one of them to sell as well. But for those who aren't interested in, say, picking individual stocks, there is also the QQQ ETF. Now, this gives you a bit more security, as you can see, it does hold a performance of over 100 of the largest non-financial companies listed in the Nasdaq. In terms of the expense ratio, it does sit at 0.2%. And as we can see in their top 10 holdings, they do cover every single one that we are about to go through today. So this is an alternative just to take a look at if you aren't someone who wants to look at growth on an individual basis. So we're going to take a look at each one individually. We'll look at the historical performance. We'll also look at the ratings that they're all given across the analysts. And as always, importantly as well, we're going to run them through the valuation model. We're going to get to our own intrinsic value, our acceptable buy price, given our investor margin of safety, as well as looking to Wall Street, what they think the price will hit over the next 12 months. Remember, one of these we do believe is a strong buy, one of these is a sell, and the others we will look to just hold. So the first one that we are taking a look at, it is Apple Incorporated. We do note a buy rating from Wall Street, a double hold, seeking alpha and quant. It is trading towards the upper end of the 52-week range. In terms of a forward yield, 0.53%. And in terms of their performance, well, they are up around 10% over the last 12 months. In terms of over the last 10 years, if you are a shareholder excluding dividends, you would be up 766%. We also note that isn't too far off the 52-week high of $199, and it now trades at around 28.85 as a forward P. This is substantially higher than the average of the S&P, currently around 22. In terms of the valuation, let's get straight into it. Typically on this channel, we do deep dives. We run through every single valuation model. Today's episode, we're getting straight to the summary, and this is coming to $200.03, the average of the two models we have used. In terms of the current price, it sits around $190. So what we can say in terms of a margin of safety, remember we do start with 10%, which we execute if it meets our three golden criteria: a wide moat, strong financial metrics, good forward-looking data. It doesn't currently hit that today. When we do take a look at 5%, it's pretty much around that level now. So in today's episode, Apple has a 5% MOS based on our estimates and judgments. In terms of upside, $204. Wall Street do see around 7% over the next 12 months. So for us, Apple is currently a hold out of the Magnificent Seven. We then move on to the next one, which is Microsoft, and we in fact see a strong buy rating from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Similar to Apple, it is trading towards its 52-week high. We do see a forward yield of 0.71%, forward P substantially higher, not than just the S&P, but also Apple at 35.52. Over the last year, very strong, up 34%. Over the last 10 years, if you are a shareholder, you would be fairly happy, up 947%. In terms of looking at the valuation in today's episode, again, straight to the intrinsic value. If you are enjoying this type of content, smash that like button, hit that subscribe and bell button. You are continually notified of these videos as they drop. Intrinsic value then $419, pretty much what we see around the current price. So we would say Apple in today is trading with no margin of safety. Again, different investors will like to buy these companies at a premium as they do believe it warrants it. Today's episode though, margin of safety 0. For example, if you were to have a 10% margin of safety, it would be a buy at 377. In terms of Wall Street and their forecast, well, over the next 12 months, they do see some nice upside, $489, 16% implied over the year. But for us, this is one that we would say is a hold given the fact that there is no margin of safety, but we wouldn't sell it. We do see some nice upside from Wall Street at 16%, and overall it is a very strong stock to hold just over the long term. We then move on to the next stock, which is Alphabet, and we have a triple buy rating, a double buy from Seeking Alpha and Wall Street, a strong buy from Quant. We can see pretty much trading right there at the 52-week high. This is one that's recently started to pay a dividend, and in terms of the forward P, 23.37, just marginally above the S&P. Over the last year, strong performance, up 46%. Over the last 10 years, if you are a shareholder, you would be up around 525. And again, just as a reminder, they have started to pay a dividend to shareholders. In terms of the valuation, then in today's episode, the intrinsic value is arriving around $209. In terms of the current price, 176. MOS level, 10%, so a buy up to 188 if you believe that is sufficient. In terms of 15%, well, we can see that is pretty much at the current trading price. So we do believe that is substantial enough for a company of this quality like Alphabet. In terms of Wall Street, well, they see upside of 11%, their price target $196, and we would indicate, based on the MOS level and the future prospects with AI for this company, that Alphabet in today's value is a buy. Now, if you do want a deeper dive of this company, it is one that we have reviewed not too long ago on the channel. We then move on to the next one, which is Amazon. We have another strong buy from Wall Street, a buy from Seeking Alpha, a hold from Quant, and as we can see, trading right there, similar to the others, towards its 52-week high. We do note a forward PE 41, so again, very, very expensive, although that is only if you use that model in isolation, which we don't recommend. In terms of over the last 12 months, though, up 60%. Over the last 10 years, up more than 1,000%. So a very strong historical performer. That is Amazon.com Incorporated. In terms of the valuation, well, let's get straight to it. Intrinsic value in today's episode is purely just the DCF model, $185. So in terms of the current price, that is pretty much around where it's at. So similar to Microsoft, we do believe that Amazon is trading pretty much near enough its intrinsic value, so 0% margin of safety. Again, 10% MOS level, if you are anticipating that, a buy would be around $167. In terms of Wall Street, well, over the next 12 months, they do see some very strong upside. They have 19%, their price target $220, and for us, this is one that we would classify as a hold. It isn't one that we would look to buy, given it is trading around our intrinsic value, but we do like this for the longer term, so it isn't one that we would be looking to sell. We then move on to Nvidia, which is also reporting its earnings in a few days' time. We have a strong buy rating from Wall Street, a buy from Seeking Alpha, and a hold from Quant. Again, the trend is very similar, right there towards its 52-week high. It does have a yield, although you could argue non-existent at 0.02%, and a forward P at 36.6. Incredible performance just over the last 12 months, up 206%. Over the last 10 years, well, phenomenal, up nearly 20,000%. Very, very strong performer. But as always, past performance is not an indicator of the future performance. In terms of the valuation, well, let's get straight to it. The intrinsic value is coming to just over $1,000, with the current price around $925. The MOS level at 10% indicates a buy up to $965. At 15%, it isn't quite there yet. So we would say somewhere between 10 to 15% margin of safety. In terms of Wall Street's forecast over the next 12 months, well, they do see upside of around 12%. Their price target just over $1,000, not too far off our intrinsic value as well. So again, this is one with a margin of safety of just 10%. We would probably hold for now. Not one we would sell, but also not one we would buy, especially with the earnings coming just a few days' time. Also, just to let you know, we have released our latest free weekly article. If you want to gain access to this, all free, click on the pinned comment below, instant access. Our latest one running through 20 undervalued dividend stocks to buy for the portfolio. We also have lots of other articles, including this one here on how to find undervalued stocks, where we run through all of the websites, all of the screeners that we use for our own analysis as well. The next one we are looking at is Meta Platforms, another strong buy rating from Wall Street, a buy from Seeking Alpha, and a hold from Quant. As we can see, trading towards its 52-week high. Again, they have recently implied a dividend with a trailing 12-month yield of 0.11%. Another one that's forward P around 24, so fairly reasonable, similar to that of Alphabet. Over the last year, very strong performance, up 95%. Over the last 10 years, again, equally strong, 668%. We can also see it was trading as low as $90 not too long ago. So in terms of the valuation of Meta, when we get to it, let's take a look, see what type of margin of safety we are anticipating today. $532 with the current price, $472. Margin of safety at 10%. Pretty much around the current trading price. And in terms of Wall Street, they see around 11% upside. Price target $523. So again, one with just a 10% MOS level in today's value, it is one that we would be looking to hold. Not one that we would be looking to sell, and again, not one that has a sufficient MOS to be buying today. We then move on to the final Mag 7 company. It is Tesla, where we have a triple hold rating. Interestingly, not near its 52-week high like the others. In fact, near enough to its 52-week low. No dividend yield currently, and with a forward P of just under 70, it does make it the most expensive one based on that valuation today. Over the last year, it is up only 2%. Over the last 10 years, however, some very strong performance, up 1,196%. And when we do take a look at the valuation in today, the intrinsic value is solely off the DCF model at 178. And as we can see in today's value, it is pretty much trading at that value. So we do believe no margin of safety. Again, if you were looking for at least 10%, it would be around 161, which it was there not too long ago. In terms of Wall Street and their forecast, well, we can see very minimal upside, only 2%, and their price target $180. So as we can see, not only our intrinsic value, but also Wall Street, we do see this pretty much trading at its intrinsic value with very minimal upside. Therefore, in today's episode, Tesla does become a stock that we would look to sell out of the Mag 7. And as we did say earlier, Alphabet does look to be the one with a nice margin of safety as well as some nice implied upside over the next 12 months. Now, in terms of looking at their historical performance, how have they performed? When we do take a look at the last 12 months, Nvidia the best performing, up 206%. When we compare that to the worst performing Tesla, only up 2%. When we expand this, interestingly, over the last 5 years, the results change very slightly. Nvidia up significantly, 2,279%. And we can, in fact, see that Amazon, the worst performing, although still very strong, up 98%. When we extend that over the last 10 years, we note Nvidia an incredible performance, up 20,913%. We can also see Google, the worst performing, still very, very strong, up 525%. Now, just as a recap, over those 7 stocks, we can see the analyst ratings. In fact, we have 4 buys or very strong buys by Wall Street: Microsoft, Meta, Amazon, and Nvidia. And when we do take a look at Google, the one that we do recommend, we do have a triple buy rating with essentially Quest giving it a strong buy. As always though, do let us know your thoughts in the comments below, whether or not you are looking to buy any of these in the Mag 7, maybe you're looking to hold, or maybe in fact you are looking to sell some of these. Interestingly, the one that we do recommend as a sell out of all of them will be Tesla, and as we can see, it does have a triple hold rating. Now, one thing that we also want to do just before we end today's episode is look at a more recent article where it does run through the Magnificent 7 just to compare it with our results and which one they do see has the most upside and the recommended buy. So in terms of looking at them straight away, we can see they believe Amazon, an 18% upside, is one to buy, alongside Alphabet, as we can see, with also a 15% upside, and in fact also Microsoft. The only issue that we did have when we were reviewing it on our side, we thought that both Amazon as well as Microsoft are currently trading near enough their intrinsic value. But no surprises, one that we can agree on is that Tesla is one that has very limited upside over the next 12 months. As always though, do let us know your thoughts in the comments below. Do you also agree with this, or do you have some different conclusions? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.